as we wrap up the second quarter of trading, we're at that halfway point for the year. The S&P 500 is off to one of its worst starts in history. And what I wanted to do in today's video is take a very large picture view of the major 4 U.S. indexes, some major commodities, as well as the U.S. dollar. And so what we've got up on the screen for us today are quarterly candlesticks. So each candlestick on this chart represents a quarter of trading, and this chart of the S&P 500 starts all the way back at the year 1929. Now, immediately what stands out is that we have 2 down quarters in a row this year, and that is a very rare occurrence. We don't see 2 red quarters in a row very often. It happened in 2016, 2013, 2007, 2000. Then we got to go back to the mid-1990s, and before that we have to go all the way back to the 80s, and then it happened a few times in the 70s where we saw some multi-year type sell-offs. What I will say is in the 2015 and our 2013 zone, those were very small first candles, and I'm going to zoom in so you can see what I mean. We were hardly red here in 2015-16. Hardly red, and we were barely red here as well in that first candle. This year we have seen 2 big down candles, which is a very rare occurrence, and again, the last time that has happened has preceded 2 major sell-offs. We saw that in 2009, we saw that in 2000, and then we have to go all the way back to 84, where we had that pullback for a year and a half, to in the 70s where we had those big sell-offs, and in the mid 60s, and this ultimately had 2 big candles down, but it marked the bottom in the early 1960s. So when we have 2 big quarterly candles down, it has preceded some of the worst price action moving forward, which is not something investors want to hear at this point in time. What I will say is we do have some very clear levels of support that still are in play that we haven't broken. So we actually haven't made a lower low on a quarterly chart, meaning we could backtest that 3,300 on the S&P 500 zone, hold that. That would be that 2020 breakout, and this would just be a breakout backtest pattern, which would be perfectly healthy in the long-term view of charts. So while we may still be in for some more pain here in the short term, if we don't lose this major price level, our major long-term charts are still very much intact. And that, when you're taking a look at a 3, a 5, a 10-year horizon in terms of investments, is a good thing. If we take out the low from 2020, that would be where we no longer have a series of higher lows, and that would actually break the uptrend that's been in place since 2009. So that's going to be the must-hold level, and bulls really want to see us hold right around that 31 to 3,300 zone and not even fall back into this zone at all. And that's what we're watching on these long-term quarterly charts for the S&P 500. The NASDAQ, very similar price action, right? We have 2 big red down quarters. The last time we saw that happen, 08, and the dot-com bubble unwind. This chart only goes back to 1986, but you can see there's only a couple of down double quarters in a row, just like we saw in the S&P 500. And when we have large ones, they have preceded some strong sell-offs. So the same kind of comments apply. When we look at the major long-term chart, the major levels right around that 5,000 zone, and we have good support in around that 8,000 to that breakout from the 2020 level right at that big round 10,000 number. So same kind of comments apply. We hold this zone. We still have the prolonged long-term quarterly uptrend that is in play. If we break below those levels, that would change the chart. But when we look at this from, again, a long-term perspective, our major long-term uptrends are still intact. Even though this year has not felt good, we haven't made those lower lows. These long-term uptrends are still intact. And here's the Dow. Same comments apply. Our long-term uptrend still intact, right? Held the breakout here. The major level right around that 27,000 to 30,000 level, right? If we hold this zone, that's perfectly normal price action. We have 2 big down red quarters. And again, same kind of comments apply. It's very rare to see that happen. We did see that in 2015 where we actually had 3, but it was really that 08. And even in the dot-com, right, the Dow held up so much better, right? Value held much, much better. We got 2 red quarters, but we didn't really kind of fall until 2003. It held up much, much better, right? So the 2 big red quarters here across all of the major indexes, right, this time around. When we take a look in at the Russell, this chart only goes back to 1997, right? For the Russell index, our uptrend is still intact, and you can see this uptrend channel, right? It is sitting right on this major level, and you can clearly see this on the quarterly chart. This is a must-hold zone. It's like right around this 16.5 level, 1650 level. Needs to hold, right? If that doesn't hold, our next area of support is much lower down around that 1,000 zone, and that would break that long-term uptrend. So for right now, again, as bad as this is felt, right, coming down in here and doing this on a long-term time frame would be perfectly normal channel uptrend trading. Now let's take a look in at some commodities. All right, oil, right, has come off a little bit here. When we look at the major quarterly chart, there is major price action in this 110 zone, and we have seen that the way this is traded on a daily basis here over the last month or so. We have not been able to break out to those new all-time highs, and we're fighting to hold that 110 zone, right? This is a huge, uptrend of every single quarter has been green since we bottomed in 2020. That is one of the longest uptrends. It might be the longest uptrend in terms of a quarterly basis without having any quarterly red candles in oil ever. Even this run that we had here, we have multiple, pullbacks along the way, and it continues on. The uptrend is very much intact, but it is stalling out right at this major 110 level. This is what we're paying very close attention to. It would be good to see this come back down, digest some of this gain. 75 is the major next level of support to the downside. That would give some relief at the pump. And speaking about giving relief at the pump, we'll take a look in at gasoline. Gasoline, this chart only goes back to 2006, but you can see we are going to close, if we don't pull back a percent, 2 or 3% more today, we'll close at the highest quarterly close ever on gas. That's not really what the bulls want to see for the overall market, because again, high gas prices are something people have to pay because they still need to travel, they still have to go to work and those type of things. So it basically takes that excess capital out of buying goods, going on vacation, things of that nature. And so lower gas prices would be very much welcome. The major level of support is in around that 220 zone, right? Cooling off, pulling back down as we get through that, summer months where gas prices typically, seasonality tends to be high, would be a very welcome sign. But this is a major battleground level, right? So the fact that we are going to close at the highest all-time quarterly close, this chart still has potential for some upside movement, not that we want that to happen. Next, I want to take a look in actually at nat gas as the last energy. We have seen this major $6 level play out for the last 12 years. And we are going to get that close, it looks like this quarter, over that zone. Next major level is way up here around that 13.5. Nat gas is very, very volatile, makes some huge moves. But it looks like we're going to get that quarterly close over that key $6 level. But this candle is not the most bullish candle. This is it pushed way up, and sellers were able to drive it back down. This type of upper wick has preceded some big pullbacks in the past, like this candle and this candle. So we're going to be watching this very closely. A move back underneath of 6 in the next quarter, and a push, especially under that 570 zone, really would show some potential for further downside, which would be very welcome, again, from an energy cost perspective. I want to take a look in next at emerging markets. Emerging markets have actually had 4 quarterly slides and continues to be extremely weak. And this is a major resistance zone. You can almost look at this as a false breakout over that 48, right? The uptrend is still technically in play, where we have higher lows, and we do technically still have higher highs, but barely. I would say this is more of a non-trending market with slightly higher lows for the last decade and a half. The major level to watch is going to be this 30 zone, because that is the area that must hold, or the emerging markets end up putting in a decade-long potential topping pattern, which is definitely not what we want to see. We like seeing the emerging markets perform well because that is a risk-on area of the market, and so we're really watching what is going on here. The last thing I want to take a look at is the US dollar and then gold. The US dollar is getting that highest quarterly close that it has had since 2003, right? This is the last highest quarterly close up in here in 2002, 2003. This is an extremely strong move. This is a decade-long breakout, not quite a decade, about 8-year-long breakout here, pushing up. And this is a clean closing near the top end of that candle. The dollar looks exceedingly strong here, which is again going to put pressure on emerging markets, going to put pressure on commodities as those things are priced in the US dollar. And this right here has the potential to make that run back up. If you look at the size of this zone, this is a 20-point zone. A 20-point move above that puts us right back up into this 124 zone, which would put us back to that all-time high. So that is the potential out of the US dollar, and we're going to pay very, very close attention to what is going on there. Now, last but not least, I want to take a look at gold. Gold on a quarterly basis, right, still looks like that big long-term cup and handle it's playing out over the course of a few years. This had an unbelievably incredible run. It took a decade worth of consolidation, potential cup action. It hasn't done much of anything this year. It's basically flat for the year, which is a way outperformance against the rest of the indexes. But you can see the importance price action of this zone here, and we're watching that very closely. A move back underneath of this would kind of negate that cup and handle pattern, and a move above would be extremely bullish. This again has really just spent the last year and a half trading inside of a range. When we look at this on a quarterly basis, it doesn't look exciting whatsoever. When you zoom in and look at it on a daily basis, it kind of looks like an EKG chart with big moves up, big moves down. So we're going to continue to pay very, very close attention to what goes on in the gold space, but for now it is still just hanging out inside this pretty decent size range and has no clear direction either up or down. The way this resolves is going to be very, very important, and we're, of course, paying very close attention to that. So while the start of this year has not been a lot of fun for the bulls, the bottom line is the major long-term uptrends in the market are still in play. When we back things out and look at things in on those major quarterly time frames, we still have those uptrends that are in play. Now, the areas of support are still below us. We may be in for some more pain, as historically when we have two red quarters like that, we have a couple of more that tend to happen. It doesn't happen all the time. As long as we hold those major long-term support levels, we still are in good shape from the long-term perspective of the overall market. We'll continue to stay on top of all these things for you guys. Have yourselves a great day. We'll see you later. Take care.